They're quite early in the morning. We know that some people have trouble getting into town due to the cyber spare. But let's get started already. So on behalf of the Liquidators team, a very warm welcome from our side. We are very happy to host the What's Up Digital Lending event for the third time this year. And we are looking forward to all of the panel discussions we will be having today. If you have any questions, need anything, please do get in touch to the organizational team. We will be around for the entire day. And without further ado, I hand over to David Eckner from Chartered Investments on behalf of the Digital Lending Association.
Thank you, guys. Also for me, welcome to the third What's Up Digital Lending conference in Frankfurt. So my name is David Eckner. I'm representing DLA. Just newly appointed to the board, which is extremely pleasurable to have this opening remark right now. And when I look at the agenda, it's quite packed. However, we got a lot of breaks in the program, assuring that you have possibility to network, because that's basically all about that conference. And without any further ado, and given that we don't want to stretch out the schedule tremendously, it's my very, very pleasure to introduce you the keynote speaker of our conference, Samuel Duncombe. He's advisor to VF Capital with extensive experience in private markets. He has been in leading roles with inter alia, Allianz Global Investors and Palladio Partners. He covers basically fund and manager due diligence, research, and portfolio management. He's a CFA Kaya chart holder representing the German chapter of CFA here. And also, which is pleasurable because I'm half academic, half practitioner. He's also research at the University of Exeter on private markets and related topics. My very pleasure. So.
Thank you very much. $1.7 trillion. That's the size of the private debt market by assets under management as we stand today. And if we believe the industry estimates, that figure could climb to $3 trillion by the end of this decade. It's just over 4 years away. When I think about those two numbers, I feel that we should be asking ourselves two critical questions. The first, what will it take for private debt to grow in this way? And the second, if it does, what will the private debt market of the future look like? I've perhaps somewhat foolishly agreed and attempted answering those two questions today. As I do so over the course of the next 15 or 20 minutes, I'd like to challenge you in the audience today as digital lending experts to ask yourselves a further question, and that is, what role will digital lending play in the private debt market of tomorrow? Before I dive in, let me quickly address the title that you see on the agenda. Crystal balling private debt. Now, I must disappoint you. I don't actually own a crystal ball. And if I did, I like to think that I'd be a Bitcoin billionaire lying on a beach somewhere instead of standing here. Instead, as mere mortals, all we can do is look at existing data and trends and try to challenge assumptions, to sketch out a picture of where we think this industry might go. And when I do that, I see an asset class at a critical juncture. If I can allow myself one bold statement to start, since the global financial crisis, which I think it's the birth of the private debt market as we know it today, there has never been more opportunity and there have never been more challenges than we see for private debt right now. So without further ado, I'd like to get into it. What do we need to see for private debt to keep growing? Well, the first challenge, or the first opportunity, I should say, that we should talk about is the democratization of private markets, the most talked about topic in finance at the moment. Retail assets are coming. By 2030, estimates are that global assets under management across all asset classes, about 60% of them will be retail assets. And if private debt and fund managers want to achieve the trajectory that we just heard, then they need to play their piece of the pie. And if I look at the data, there are 75 LTIFs and LTAFs, so retail vehicles or retail accessible vehicles in Europe and the UK in the private debt space. Of those, more than 1/3 were launched this year. That's more than double 2024 already, and the year isn't over yet. So the momentum is there. But retail assets bring with them new challenges as well. For a start, individual investors are afforded much greater regulatory protection. And with regulatory protection comes greater calls for transparency. There comes greater administrative burdens for fund managers. And, perhaps most importantly, calls for liquidity. Whereas institutional investors are generally able and quite happy to lock capital up for the typical 7-year period that you see in a classic private debt fund, individual investors want access to their money. They want to be able to withdraw it when they like and deploy it when they like. Hence the shift to open-ended vehicles, and in practice, periodic liquidity windows. And that has a very important consequence, because if open-ended vehicles allow retail investors to put money in and out of a vehicle at a stated net asset value, then interim valuations become much, much more important. They go from being a book value, an accounting value, or a reference point, to being, in effect, a market price. And this would invariably bring with it much greater scrutiny of how fund managers value assets over the medium to long term. Now, if that happens, we should see the consequences how returns look as well. So I don't think that the democratization of private markets will lead to greater volatility in private debt in and of itself, but it will perhaps pull back the cover and reveal volatility that's always been there through the use of WUDL-driven valuations. There's also a further consequence that I'd like to touch. In the last years, we've seen an increasing concentration amongst private debt assets amongst the largest fund managers and the largest funds. The average fund size has been increasing for quite a while now. And democratization will likely support this trend, because all those factors that I spoke about, the need for greater regulatory oversight, liquidity, administrative hurdles, large fund managers and asset management groups are simply better placed to execute that. So their structural advantage will probably increase. And what might follow on from that is further consolidation in the industry. We've already seen a number of smaller private debt funds, and there are a few examples from the last year or two, even here in Germany, being acquired by larger asset management platforms or larger competitors. And it makes sense. If a large platform and scale is a prerequisite for gathering assets from the retail channel, then a private debt team has a higher value on a large platform than it does at a subscale boutique. But retail assets alone are not going to define the future of private debt. Even if you look at the statements that have been made publicly by some of the very large managers, they're aiming at about 25% of new fundraising to come through the wealth channel, it's a big amount. A number of years ago, that was virtually zero. It was non-existent. This is just a new additional 25% for all intents and purposes. But to grow and to carry on growing, private debt and the private debt industry must do something else as well, and that's to overcome the current market challenges. But make no mistake, it's a very difficult market for private debt managers at the moment. To see why that's the case, I'd like to take a step back and look at maybe the macro environment in which private debt grew. So private debt was built in something of a golden age. We had no interest rates, we had an active M&A market, an active IPO market. There's a lot of capital from investors hungry to deploy. That was a very tasty cocktail, and fundraising was quite successful. And now we see perhaps a hangover from that period. Rates are higher, the M&A market is much more muted, And the IPO market, well, it's certainly not anywhere near as wide open as it was. So we have a disparity. You have a challenge. We have a lot of assets to be deployed and limited deals to fund. That makes, of course, for heightened competition amongst lenders as well, which seems to have led to deterioration in terms and conditions. So if we look at what's happening in the market, we can see that, well, if we think back to 2013, leverage levels were much more muted than they are today. And not only were leverage levels lower, they were much easier to understand. We didn't have EBITDA adjustments the same way we do today. You didn't have to read through a long list of adjustments just to understand what was actually being measured. Maintenance covenants used to be part and parcel of the industry back in 2013. Nowadays, much rarer and often replaced with springing versions that only really bite when it's too late. Now, this all sounds rather negative, and it's especially so if you consider that margins and spreads have probably declined as well over the same period. That's not a great sales pitch for the industry. Worse conditions, lower returns. So what do we do? Well, I think the first point to point out is that getting into this situation, there are a lot of managers trying to do essentially the same thing, right? There's a lot of capital raised by funds that are more and more similar. The transactions are more and more similar. So competition was there. We were very vulnerable to heightened competition adjustments. Diversification could be a good solution to this. And I think if you look at the private debt market even today, then this is globally, in Europe it's perhaps a bit less so. But by number, not by volume, by number, over 50% or approximately 50% of private debt funds raised are actually outside of the traditional direct lending space. Right? As investors, you have access to mezzanine, growth debt, distressed, stressed opportunities. And if you go further down the size spectrum, you'll find funds that allocate to niche markets in a specialized way where the barriers to entry are higher, right? Which insulates them to an extent at least from these general market conditions. But make no mistake, it's still tough, right? To just give you a statistic on this, last year, 231 private debt funds were raised. That's approximately half the number that were raised when the fundraising market was at its peak in 2022. It's also the lowest figure for a decade. Given the remarkable growth of this industry, I think that's a pretty stark reminder of where we stand. So, where does digital lending fit in? Well, I think there have been many areas of the market, although I've just made a case that the market's much broader than simply direct lending. There have still been many areas of the market that private debt funds haven't been able to penetrate. When I say marketing, then the lending market. And the reason they aren't able to do that is because private debt funds, they don't have a branch network like banks do. They also operate at a data deficit. And by that, I just simply mean that they don't have access to the large amount of data that banks see. Borrower data across industries, across sectors, and at the borrower level. And they also lack, typically, the means of capturing and analyzing that data. And I think this is where digital lending actually becomes really interesting for the private debt market, because it can circumvent the need for the physical banking infrastructure and allow investors access to parts of the market that were previously inaccessible. Now, this should be a very, very attractive proposition to investors in the private debt space. For a start, by accessing different areas, and with a digital lending platform, no borrower, no company is too small. So you can access industries that were previously ignored, or other asset classes even, that previously the ticket sizes were just too small to be interesting for private debt funds. That's no longer the case. If these can be originated and executed at scale and bundled, then that's a new way that private debt investors can diversify their portfolios. But I'll be a little cautious in my prediction as well, because I think the value proposition that digital lenders have within the private debt space was very strong. But value proposition alone is not enough. In addition to having an attractive investment strategy, even if you have a track record and proof of concept, to succeed, particularly at the moment, you need scale. If we think of a typical small institutional investment ticket, maybe 10 million euros, you need really to have a fund of 100 million euros, just so concentration limits then become an issue. And anything below that sort of size, the burden of administrative costs and operating costs of running a private market fund structure are going to start to look quite prohibitive. And particularly in that current fundraising market, raising that sort of volume may well prove to be a large hurdle. But I don't want to end on a negative note. In fact, I'm very positive on the future of the private debt market. I think that private debt will weather the current storm. I think there's simply too much appetite for non-bank credit for that not to be the case. And I think as investors mature, they'll be more and more willing to look outside of the classic private debt direct lending strategies, and the market will get broader and more resilient for it. But if I can come back to the question I asked at the start, which was, what will the future of private debt look like? I'll try to summarize briefly a couple of points. So first, democratization. It's already providing new vehicles, including liquidity provisions for investors who need that. I think it will bring with it much more regulatory scrutiny, particularly among valuations, which will make the asset class potentially look more volatile and hopefully give us a more honest reading of where risk to return sits. To overcome the challenging market at the moment, I think large fund managers will diversify their product platform. They'll offer more and different strategies and make them more accessible to investors. The state of the current fundraising market would also suggest that fee pressure will continue, so these strategies might not just become more accessible, they'll also become cheaper. Unfortunately, small fund managers, I think, have an uphill battle ahead of them. Without the advantages of scale, it's going to be a tough time. Some will likely become acquisition targets for their larger peers. Others may simply leave the market. But the very best, I think there will be a place. In a sense, we could see this as a bifurcation of the market. On the one hand, you'll have the large managers, large asset management platforms that look more like department stores. And then you'll have the high-performing boutiques that can justify a higher fee structure, which they'll need to cover their costs through superior returns and access to parts of the market with high barriers to entry. And turning back to the third question, the one that I posed to you in the audience today, what will the role of digital lending be? Well, I think that's in your hands. So I look forward to hearing from the other speakers today to find out more about which way we'll be going. Thank you very much. It was a pleasure being here. If you have any questions, I'd be happy to answer them, either here now or I'll be hanging around today as well.